Okay, so now we are on reading 18, understanding business cycles. Basic idea, so the reading that we just concluded focused on long-term economic growth. So it talked about aggregate demand, aggregate supply, how can we boost our economy, how do we increase productivity. So basically a long-run perspective. And economists in general agree on what it is that causes long-term economic growth. But the part where there is lots of different opinions is what to do in the short run, and why does the economy go through these business cycles. How come we are in a recession now when 2 years ago we were in a boom? So these changes in economic activity are referred to as the business cycle. What causes the business cycle and how to minimize the impact of the business cycle is a subject that is heavily debated, and even very, very smart PhDs in economics have different opinions on this. And this is extremely important because your view on this subject then determines what appropriate policy actions are. So this is the precursor to our next reading, which will be on monetary policy and fiscal policy. So the sorts of things that we'll talk about is we'll understand what a business cycle is, what are the phases of a business cycle, and from an investor perspective, it's important for us to understand what is the behavior of businesses and households in these phases. Why is it important for us as investors or financial analysts? Because there are different businesses that will perform differently depending on the state of the business cycle, and we need to be able to predict for example, if given whatever state we are in now, we need to be able to predict whether we are moving from a recession into an expansion or from an expansion into a recession. So as analysts, we should have a sense for this basic economic information. So we'll talk about different theories that try to explain business cycles, and these different theories have different suggestions for how to deal with it. We'll talk about unemployment and inflation and variables which can help predict the economy. These are called economic indicators. So let's first talk about the business cycle. I'm sure you've seen this picture. So what you are seeing here is a very simplistic view of a business cycle, where the x-axis is basically time and the y-axis represents national economic activity. Sometimes you will see this y-axis written as the GDP, which is a measure of economic activity. Sometimes you will see it as GDP growth rate, but something on the y-axis basically will be giving you an indication of economic activity. This straight line over here is suggesting that the overall economic activity is rising. So this is indicating growth in the economy. So overall steady growth in the output of a given country, or the economic output of a given economy. And this cycle over here is saying that at any given point in time, the output is either above what would be expected or below what is expected. So I think everybody here has seen this to some extent. Over the last 10 years in Pakistan, there have been times where the economy has been doing really well, and then there are times when the economy is in some sort of a trough. So these days we are probably somewhere over here. Okay. What's that? Yeah. Okay. In some countries the trough is longer than we would like it to be, but we'll always come out of it. Okay. So we move up to a peak and then come back down. So on this slide, just understand the terminology. The straight line is telling you a growth trend in different countries. So in China, for example, this is a very steep line. In some countries it might be less steep, but this is a measure of your economic growth. The slope of this line is a measure of your economic growth. This is called a peak. As you move down, as GDP or your activity goes down, that's called a contraction, and sometimes also referred to as a recession. And then once you come out of a trough and start moving up, that's called expansion. Now this is an exhibit from the curriculum. I forget which exhibit. I think it's probably number 1, and something that you need to understand. What this is telling you is what so it's telling you that at different phases or different parts of the business cycle, what can you expect in terms of economic activity, employment, inflation, consumer and business spending. So we have the early expansion, late expansion, peak and contraction / recession. The way this can be, I'll just create a business cycle over here and then explain and go through this slide. So an early expansion would be, so if we are coming out of a trough and the economy or economic activity is going up. Late expansion, the economy is still growing but at a lower rate, so we reach some sort of a peak, and then this is a contraction where the economy is going down. So again, this is over here, time is on the x-axis, economic activity is on the y-axis. So when you are in this early expansion phase, what's happening to economic activity? As you might imagine, the economic activity is measured by the GDP. So GDP, industrial production and other measures of economic activity turn from a decline over here to a increase. What happens to employment? So at this stage you have layoffs, people being fired, unemployment is high, but as you turn around, then layoffs slow down. New hiring does not occur very fast. Why? Because businesses are waiting to see that are we actually getting out of this recession. Businesses hate to hire people unless they are sure that there is work. So they will slowly, maybe initially they'll start taking temporary workers, and once they feel comfortable that the business is good or we are indeed going to have better economic times, then they will move into hiring. So employment picture is slowly improving. Inflation remains moderate. Generally, when you are in a recession, inflation is low, generally, globally. And at least in the early part, typically inflation remains moderate. And what about consumer and business spending? So normally there is a slow upturn in housing. So as the economy improves, people might start buying houses. A slow upturn in consumer goods and light equipment. So from a business perspective, they will still be reluctant investing in heavy equipment and large capital, but they might start buying light equipment. Then in the late expansion, once it becomes clear that we are in an expansionary phase, economic activity shows an accelerating rate of growth. So we are roughly over here. Businesses begin full-time hiring, unemployment rate falls, inflation picks up, and now businesses also start ordering heavy equipment, construction might begin, and so on. The rest I will have you read yourself, but I think from an exam perspective, understanding and remembering this exhibit is extremely important. I didn't see anything exactly like this in Schwezer, so I would say that this particular exhibit, make sure you do it from the curriculum. Okay, the curriculum has several good questions that you will not see in Schwezer, so even if you don't read the curriculum, at least do the exhibits and make sure you go through all the questions in the curriculum, both at the end of the reading as well as in the reading. So the questions that I've cut paste here are from the reading itself. Which of the following rules is most commonly used to determine when recessions start? Okay, I've not explicitly said this. You might have read this in your economics textbooks, but I'll just, how many people know this? Yeah, so if you didn't know this before, you know it now. This is not a perfect measure, but to determine when a recession starts, basically you look at a situation where real GDP has 2 consecutive quarters of negative growth. So this is a commonly used indicator for whether we are in a recession or not. So that's why very often economists can't tell you are we in a recession now or not, because they have to wait for 2 economic quarters to see whether the real activity or real GDP went down or not. But this is not perfect. What happens if GDP goes down and then marginally goes up and then goes down again? Is that a recession or not a recession? Well, strictly speaking, it's not, but it feels a lot like one. So the point is that this is not a perfect measure, but it's still commonly used. Okay. Now, what if you are in a country where whether we are in a recession or not, and the GDP and so on is not measured very, very well? So what are the sort of indicators that you would look at to estimate whether you are at the peak of a business cycle or whether you are in a trough of a business cycle? Any ideas? Yeah, a big one, you would look at unemployment/employment. You would look at GDP growth rates. So right now in our country, the GDP growth rate is low, unemployment is high. You would look at industrial production. So if this is high, that means we are at a peak. If it's relatively low, it means we are at a trough. We'd look at inflation numbers, which in general, if you are in the late phase of economic expansion, inflation numbers will be high. If you are in a peak or trough, then inflation numbers would be relatively low. Okay. Now, a general point on usage of resources through the business cycle, and I will relate this to aggregate demand, aggregate supply that we've talked about briefly. Let's say you have a situation where there is a economic downturn. So if there is an economic downturn, let's just look at something here. So initially, let's say you have a situation where you have aggregate demand curve, aggregate supply curve. Now let's say that initially you are in a situation where the aggregate demand is actually is actually over here, and let's say that if this is the long run aggregate supply, is this an inflationary gap or a recessionary gap? This is inflationary because our output here is above potential GDP. This long run aggregate supply represents our potential GDP. Now it might happen that if the government or the monetary authority sees a situation like this, as we'll discuss later, but just to give you a brief sense, what the monetary authority might do is cut back a little bit. So they might increase interest rates. When that happens, that will pull the aggregate demand curve backwards. But when aggregate demand comes down, what else happens? Then from a company perspective, your inventories will start to accumulate, because if the aggregate demand is down, then all the inventory that companies have built up, they'll have trouble selling it. That means inventory balances will go up. When inventories go up at companies, what do they do to production? Yeah, they decrease the production. If production goes down, what happens to employment? So unemployment goes up, employment goes down. So we again have less labor and lower capital utilization. So people now have even less money. So consumption goes further down, and that will potentially further push the aggregate demand curve. So often it might happen that the monetary authority is trying to deal with this inflationary gap, and through their policy actions they actually might trigger a recession. So just put this in mind that this is a possible scenario. Okay, so that this is actually exhibit 2 in the curriculum, and what we have described is a policy triggered recession, and the logic is given up here. When you talk about an output gap, I discussed this earlier. What is a output gap in a recession? Just to give you a quick sense, if at a given point in time, let's say this is your long run aggregate supply, and at a given point in time your equilibrium is at this point A. What is your potential GDP? It's this. This distance is referred to as a output gap, because the amount that you are producing is A, the amount that you can potentially or that you should potentially produce is P. So this distance in here is referred to as a output gap. Okay, next. Okay, so that's a good question. The question is there an output gap when we have inflation? There is a gap, but the name of that gap is called the inflationary gap. So when you have a situation like this, where you have this is your short run equilibrium, and that short run equilibrium, let's say this is point B, that is to the right of potential. This happens when you have an overheated economy, maybe in the late phase of a expansion or at the peak. At the peak of a business cycle, you might have a situation like this. This gap is referred to as an inflationary gap. So again, there is a gap, but the name is different. Okay, now how is capital spending impacted depending on where in the business cycle you are? And again, just to set the context, what we are talking about is, so this is your business cycle. So what is the capital spending like over here? What's it like here, here, here? So that's what we are talking about. And why is this useful from an analyst perspective? You are trying to look at companies' capital spending and using that information to figure out where we are. Or at times you might have a sense for where we are in the business cycle, and based on that you are evaluating a given company and you want to see what sort of capital spending it might have. So depending on what you are trying to do, this is useful. If an economy is heading for a downturn, businesses scale back on capital spending. Is that logical? So you can tell that if businesses are scaling down, so you are looking at company orders for capital equipment going down, what does that tell you? That implies that our economy is slowing down. On the other hand, during an expansion, there is more investment in capital goods. So if you can track orders for capital goods and you see those orders going up, then that's an indicator to you that the economy seems to be improving again. The most watched indicator of future direction of capital spending is orders for capital equipment, because they precede movements in actual shipments. What is this saying? This is simply saying that if companies in Dubai have started ordering Caterpillar earth moving equipment, there is a lag between the order being placed and that Caterpillar earth mover showing up in Dubai, right? So a sensible analyst would wait and look at the shipment, or will he track the orders? He will track the orders. If those orders are going up, that means the economy in Dubai is turning around, and projects such as the Tiger Woods golf course are now going to be constructed. Okay, so that would be an indicator that economy is turning around. Now, what sorts of questions might you get? Again, some of these questions might directly come from what we've talked about. Others might require logic and common sense. Okay, it's impossible to cover everything, so you need to rely a little bit on just common sense. So let's see if you can do that here. Yeah, the correct answer here actually is C. So the most likely reason that US analysts often follow new orders for capital goods excluding defense and aircraft is actually military is part of the public sector, so what? That's still helping the economy. Aircraft and military orders are often the same, so that's clearly not right. Okay, military orders and aircraft. So that's what I meant. You just sometimes have to use common sense. So by elimination, you can hopefully arrive at C. But this, then when you read C, it is logical. Armed forces and airlines tend to place, like, have you seen the sorts of orders that large airline companies place? It's like 5 Airbuses or whatever, so billions of dollars worth of orders. So they are huge orders that come once in a while. Okay, so the correct answer is C. Orders for equipment decline before construction orders in recession. So let's say that, so again let's pick on Dubai. So construction companies in Dubai, or there are these, let's say, construction contracts. Why do the orders for equipment decline before the large construction orders? Actually B is the best answer. In general, large construction, and here again it's common sense or general knowledge, large construction orders are hard to get into and hard to get out. So if you start feeling that, okay, the economy isn't quite headed in the direction I was thinking, so I thought it would expand, but this recession or trough seems longer than I anticipated, it is easier to start getting out of your basic equipment orders, because if you need equipment again, you can just go back to Caterpillar or John Deere and place the order again. So orders that are easier to cancel, obviously you will cancel first, and then you will try to cancel your large construction orders, but that might take a longer time.
If you found this clip interesting and informative, please visit my website www.arifirfanullah.com. Here you will find a tremendous amount of useful material. Right here in the 2011 CFA video lecture series, you will find the entire level 1 curriculum for free, and most of the material here is still relevant. So this is worth looking at. The 2012 video lecture series covers both level 1 and level 2. These lectures are available for a fee. And finally, down here, financial management at IBA. Here you will find my lectures at IBA for a course on financial management. Plus you'll find lots of useful spreadsheets that can help you with financial modeling. So again, please visit www.arifirfanullah.com. Thank you.